Thank you. Every startup's dream is to be valued at more than $1 billion. The rarity of this achievement, however, has led the experts to call such startups unicorns. Indeed, closely related to the internet boom and the dot-com bubble, unicorns are a fairly recent phenomenon. The term was first used by Aileen Lee in 2013. She was the founder of Cowboy VC, a seed stage venture capital, and it was done in an article titled Welcome to the Unicorn, Learning from Billion-Dollar Startups. Along with recognizing the existence of unicorn startups, it also acknowledged Google and Facebook as the super unicorns of their respective decades. Then came decacorns and hectacorns. Big and as they are, does it truly make sense for every single startup to strive for such an ambition? Welcome to the 10th session of the Startup Caravan workshop series, Can You Create the Next Unicorn? The Do's and Don'ts and Investors Outlook. Allow me to start by extending a warm welcome to a pedigreed investor, founder of IvyCap Ventures, and our speaker of the day, Mr. Vikram Gupta, our esteemed flow members, and of course, our invaluable participants. I'm Gauri Poswal, the corporate communication and strategy head of a boutique law firm, Vertices Partners, which specializes in the startup space, PE and VC investments. As a startup enthusiast, it is an absolute pleasure to be a part of a team that's spearheading this series specifically for fellow new and aspiring entrepreneurs. The world of startup investment is vast, and just one session with an investor is not enough. Continuing our discussions with investors, today we will deep dive further into this expanse with the help of our moderator, Sheetal Desai, who has attempted to truly break down the questions to their fundamentals from our participants' perspective. Excited to hear our thoughts. Without further ado, let me hand it over to Sheetal to introduce our speaker for the day.
Thank you, Gauri, and good evening, everyone. We are thrilled to have one of the pioneers of the Indian VC community with us today. It's my privilege to introduce Mr. Vikram Gupta. Vikram Gupta is the founder and the managing partner of Ivy Ventures, a $200 million venture capital fund that invests through the alumni ecosystems. He has 25 years of experience and in private equity, business consulting, mergers and acquisitions, strategy and operations in healthcare and life sciences, education, consumer goods, and other industries. He has held leadership positions across various well-known companies in India and abroad. Prior to founding IvyCap, Mr. Gupta was the founding member at Ajay Piramal's sponsored $100 million healthcare-focused private equity fund that he conceptualized and raised in 2008, when the world markets were going through turmoil. Mr. Gupta worked in the US with IBM Business Consulting Services for over 4 years in strategy and planning, business development, and project management across various assignments. He conceptualized and led IBM's healthcare and life sciences practice for clinical genomics. He has also held senior positions with various well-known Indian companies. Mr. Gupta is the co-chairman of Private Equity and Venture Capital at ASSOCHAM and in an active member of Indian Venture Capital Association and Confederation of Indian Industry. He received Distinguished Alumnus Service Award from IIT Delhi in the year 2020. Mr. Gupta has completed his BTech in Chemical Engineering from IIT Delhi and has MBA degree in Strategy and Finance from Case Western Reserve University, Cleveland, Ohio, USA. Our audience today is FICCIFLO members and friends, aspiring entrepreneurs, students, and IITians. Welcome, Mr. Gupta, and it's great having you here. And I would like to open this discussion with unicorns. There are only about 450 of such startups worldwide. Does this mean that these companies have generated $1 billion? Interesting fact is that while established companies' valuation is done based on past year's performance, for a startup, it is derived from its projected development and growth opportunities. Rooted in the big, fast strategy, unicorns often face challenges when it comes to sustainability of value creation. And when we live in a world where we have learned the hard way that sustainability is everything. I would like to kickstart this session by inviting Mr. Gupta to share his thoughts on this aspect of unicorns and sustainability.
Thanks, Sheetal, for such an illustrious introduction. And thank you for inviting me for this session. It's great to be here. And the question you're asking is very relevant and very apt. And I think it's quite correct when Gauri said that, most of these startups uh, look for building large valuation, and I will come to the difference between valuation and value, and I think that is something that really differentiates entrepreneurs, the way I look at it. And I think you're right. Globally, in fact, yesterday I saw a report. In fact, the number of startups that actually got valued over $1 billion is actually crossed 500 now. So in fact, there was a report from CB Insights, which in fact talked about the 500th unicorn globally. And they have very nicely organized that list and structured it. And then it's very interesting to see sector-wise and geography-wise all these unicorns. It's very interesting. And this particular term has become very relevant from various perspectives, because not only this is seen as a benchmark, by the entrepreneurs, but I think the investors who invest in these entrepreneurs, from their perspective, they like to boast about the number of unicorns they have in their portfolios. And that's the reason it has become actually very, very relevant. And actually it's become even more relevant in the last 7 to 8 years, because, and of course, as time passes, we'll see new terminologies, and we are already talking about decathlons and hectacons terminologies, where we're talking about $10 billion valuations and $100 billion valuation companies, which are actually out there now, which is amazing to see. So the question really is, should one really be aiming for that right from the beginning, or how should one be looking at this whole thing, right? So my thought on that is, you can't be batting on a pitch looking at your scorecard after every ball you play, right? So you have to be focusing on the ball that's coming to you, and play each ball to its merits, and just focus on your game, and then runs will come. And in fact, when you play like that, then lots of runs come, and then you do create a lot of value. So I think you have to focus on your business. You have to focus on solving the problem that you're solving. You have to make sure that you're the way you're solving it, it is solved in the best way out there, and you are the best in solving that problem. And as long as you can achieve that, everybody else would see value in that, and they would want to give you that value, and even pay for that value. And that's how, when investors start investing in businesses where they see that generally these entrepreneurs are actually differentiated in the way they're solving the problems they're focused on. The problem is large enough that over a period of time, the size keeps growing. And the valuation is based on various parameters. To your point, Sheetal, I think its valuation, is actually looked at from various perspectives. Typically, if you look at pure from a technical perspective, if one were to look at valuing a business based on technical terms, one would look at typically the discounted cash flows that you're going to see in future, and the risk associated with those cash flows, and therefore you will try to discount that and calculate your present value and the net present value, and then therefore try to derive what's the value of the business. Of course, the key lies in the risk that you see in the business, and therefore, and different people assign different level of risks. in every business. And the risk is also associated with the value that the investor brings to the table. So that's the reason you might see, certain businesses getting valued substantially, even when they're at very early stages of their growth. Example is businesses like housing.com, which was, a business that got substantial capital from SoftBank, $90 million, when they were just doing a few lakh rupees of monthly revenues, and got valued at numbers that people just couldn't understand. As against that, you will see companies which will get valued at $1 billion ahead of their time, and then the same valuation getting revalidated after some time, and then the numbers getting or being brought down. So I think it really depends on who's actually valuing the business and what value they see themselves bringing to the table, and what value they see the business building on its own, and what stage the business is at, and who are the entrepreneurs running the business. And then there are various other factors in terms of the competition out there, who else is solving the problem, the capital efficiency of the business, the profitability, therefore. So there are quite a few factors that go into really assessing the value of the business and the risk attached to it. And different people will look at differently. So that's why you see a huge discrepancy in different businesses.
Right. So like for you mentioned about SoftBank and housing.com, and I think they were valued at what, 90 million or something. I'm not sure.
19 million was the investment amount.
Investment, sorry, yeah. But then it didn't do very well, did it?
Yeah. So I specifically gave that example also to tell you that if you don't value the business the way it should be valued at the right time, the chances are that you are in a way disturbing the mindsets of the people. And if you overvalue a business, you are impacting the mindsets of the people. If you undervalue the business, on the other hand, then there's a different level of impact. So that's the reason, especially at very early stages of the businesses, where you still don't have justification from revenues perspective, or the business model is not fully established, the product market fit is not necessarily established. People try to use all kinds of benchmarks and try to do valuations, and people try to do valuation at very early stage of the business. The chances are very high that they will end up making mistakes, and that's the reason the whole concept of safe notes when it comes to seed stage funding, which actually originated in the US, where the idea is that you just give some money to the entrepreneurs and establish a percentage that you need in the business, but that percentage is determined only at the time when an institutional investor later on and values the business based on the actual numbers of the business. Right. So therefore, at the time when you put in money, which is just a seed capital, you would not know how to value the company. Therefore, you would not mind waiting for the time when somebody who comes with a scientific method and does valuation of the business, and therefore your valuation gets back to that round, and which happens now these days quite often, where the valuations get back to the next rounds. Right. So whenever you're not sure about what number I should assign, people do that. So that's happening a lot at very early stages.
Yeah, so that's good to know. So it's at least there's some justifiable numbers, right? Or at least it's not overvalued, because in between there was a big hype and everybody was coming up with crazy numbers, and I would always wonder, how do they come up with these numbers, and how do people invest in this kind of funding? How does that work? So but I think
valuation mistakes can happen even at Series A, Series B, right? I mean, many times they get driven by how much stake I want in the company. So typically, at Series A levels, some of the VCs may have this mindset that I don't want less than 30% stake in the company, and I don't want to put more than 15 crores or 20 crores. So in a way, you have in your mind, even before you approach an entrepreneur, you've already valued a business. And if the entrepreneur doesn't understand valuation, and if the entrepreneur is not able to ask the right questions, or is able to do proper research, the entrepreneur may end up giving up that kind of evaluation to the investor. So therefore, it's very important for the entrepreneur to do a lot of research on their own, and make sure that first of all they're approaching the right investor who can add value. Because as I said, different investors assign different risks to different businesses. So if I'm an investor who understand the business, and I believe that I can also bring a lot of value on top of what the entrepreneur is going to bring. Therefore, it's not just financial investment that I'm doing. With my capital, I'm bringing a lot more value to the business, including a lot of mentorship, access to the network, access to customers, possibility to raise a much larger round later on. So there are lots of other things which the investors can bring to the table, and that can get valued very differently. So if I'm an entrepreneur, I would look at my bigger picture outcome over a period of time, rather than maximizing my value or my valuation at that point of time or in that particular round. So therefore, smart entrepreneurs will typically, first of all, do a lot of research, make sure they talk to the right investors who can bring value, and then look at the bigger picture of where this will be in 5 to 7 to 10 years, in terms of the overall value creation. And even if they get diluted over that period of time, what would that diluted stake mean at that point of time? So let's say from 100%, they come down to 50%, then 30%, let's say, even if they end up at a 10% stake after 10 years, if the valuation at that time is 10 billion, 10% of 10 billion is $1 billion. And the example is, look at how much value Sachin Bansal and Billy Bansal created for themselves at respective stakes of less than 10% at the time when they were offered the exits. So it really didn't matter what stake they were holding at that time, right? So what mattered was that they raised the money from the right investors at the right time, who were able to create a lot more value for them. So eventually, they were able to create more than $1 billion valuation for each of them.
So finding the right investor is very essential for an entrepreneur. That's my takeaway from this. And who can contribute just a lot more than just about funding, but also help you in other areas, which will help the growth of the company and scale it up, right?
Yeah.
So my next question is, what do investors look for in an entrepreneur, and at what stage should an entrepreneur approach an investor without diluting too much stake?
Yeah. So, first of all, I think each entrepreneur has a dream, right? I mean, the reason you become an entrepreneur is you believe that you can solve the problem, and you believe that you can solve it much better than anybody else. And most of the times, the entrepreneurs who I've seen become very successful, they actually experience that problem themselves. And it actually comes from the fact that they experienced a problem, or seen somebody else close enough experiencing that problem, and then they realize and they start asking questions, why is this problem not solved? And then they start looking around, who's solving that problem and why are they not solving this problem properly? Oh, I mean, there are so many gaps, and therefore I think I should do this, right? So they start with the vision of solving a particular problem. And when they start thinking through that, now there are different people behave differently, right? So there are people who would, just then start putting a presentation together, and, then they decide, do they want partners early on, or do they just want to do themselves, and maybe bring on partners later on, because the first dilution happens when you bring a partner on board, right? So if you bring a co-founder on day one, there itself, you have to decide how much equity to share with your co-founder. And this problem happens with every entrepreneur. And, if the idea originated with two people discussing with each other, it's a different story.
Yeah.
And that's a very different kind of discussion. But the idea started with one single person who thinks that that person, he or she, can actually really make a difference. And then they start working on it, and then they still need to bring a team on board. Early on, it's just an idea. So the person they bring on board has to feel equally excited about it, has to have the same vision. So the dilution starts there itself, right? So the question people have to ask themselves at that stage is, for every dilution they're doing, how much value do they see coming with that dilution? Now, I mean, I met an entrepreneur this morning who actually is working on a very interesting idea, and it's still at the idea stage. And, I like what he's doing. I like the problem he's solving, but he doesn't have a co-founder. So the first thing I asked him is basically just go find a co-founder, because he wouldn't be able to do it himself, because he doesn't have the technology skills which is required as a core of his entire approach. So unless you have a person who has this required skills to be part of the business, if you are only looking to hire those skills, who's a person who's not equally passionate about it, hiring skills versus having in the founding team, your cost is going to be very different, right? So if you have that kind of capital upfront, then, and you have conviction in your idea, and if you don't like to dilute, then you would want to maybe take that chance, because you're willing to take that risk upfront, even if you lose that money that you're putting in. I think it might work for you. On the other hand, if you think that the risk is going to be very high, and you're not going to be able to fulfill that gap for risk for that particular skill set, you may want to bring somebody on board with an equity to that person, so that the person also is equally passionate about what you are trying to do. And I think typically, that's not easy. It's not easy to get a co-founder on board having a similar vision. And I've seen lots of teams breaking up after initial period of working together and realizing that they got excited initially, and after working for some time, they just don't like each other. I mean, they just don't like each other's working styles.
Yeah.
And in the process, if there's a more than 2 people team or 3 people team, and I've seen 7 people teams, you always have that one person who just says that, okay, guys, I'm done here. I need to out. And that can happen a lot. And one needs to think through those scenarios also early on. Many times entrepreneurs don't realize that you have to think about such scenarios which can build up over time. So yeah, I think at every such decision point where you're bringing a partner on board, whether it is a co-founder or then you go to an investor, and investor also comes with some capital, and then they also expect certain things, and then they are offering certain things. That is where the assessment has to be done on both the sides, right? So many times I've seen entrepreneurs just getting excited about the money coming in. So they think that, okay, in their minds it is about, we want to raise 15 crores, we don't want to dilute more than 20%, and the first person they hit who's actually willing to offer those terms, they take the terms and then they start working. They don't realize that there were questions to be asked beyond that.
Yeah.
That person may have a very different objectives to invest in your business, may have objectives to acquire your business, and while you may have a vision to just run it for next 20 years and make a difference. So I think these are kind of questions which are very important to ask at every stage.
Yeah. So, I mean, I find that many a times the entrepreneurs get really excited. They, like you just said, start finding their co-founders. We're looking for a co-founder, and it's like a job title I'm looking for. And then at the same time, the moment they get the funds, they want to burn the money. So that was my one next question. The whole idea of, I hear a lot of burning money, and then comes the fact that they have burned the money, and all of a sudden they are looking to survive. I mean, I think, I've personally seen this up and close with people that I know, that where they have spent so much money in their marketing, advertising, and no doubt the business has rolled and everything's happening really well. But the moment they stop spending, the business disappears, and they've never thought about how to keep the business sustainable. So the whole idea is, how do you keep the business sustainable while you're burning this money that you get from the investor, and then when you have to answer the investor, you're in a flux.
Yeah, that's a very important question, Sheetal. In fact, I have seen entrepreneurs who have this notion, and I think there was this time about 5-6 years ago when, actually more than that, about 7 years ago, and I think a while ago, where people were valuing businesses just purely on the GMV basis, gross merchandise value of the, you have a platform, you're doing a distribution business, you may be making very, very low margins, 1% margin. And sometimes, there was a huge talk of Flipkart selling products at lesser than the variable price. And which means that the more you sell, the more you lose money. And I think the question really is about, at what level are you burning money? I think if you're burning capital at the contribution margin level itself, the contribution level margin where all your variable costs, and there are multiple contribution margin levels, at the basic product, the price level itself, if you are making losses, then you better have an explanation for why you are willing to make losses. If I were in Amazon starting in 1994, the first time building a concept in the minds of people, just to not knowing, whether people will ever buy online, I'm taking a huge risk at that point of time, and I continue to burn money for 10 years and, get valued during that time frame for over $1 billion. There is a reason why people see value in that business, during that time frame, because you built something for the first time that people didn't see, that you saw. You saw a new trend which is building up, which you actually helped create yourself. You knew that you had to sell your product below even the variable cost of the product to build the market. But you knew that eventually at some point, when you got the stickiness, you can command a premium. And which is the reason why when you get valued at $1 billion at the time when you're making still substantial losses, it's because of the concept I was talking about, is the net present value of your future cash flows. And people look at future cash flows of business like that, they see huge profits in the future. And when they see huge profits in the future, and when they do net present value of that, they see in fact multi-billion dollars as the net present value, and they're very happy to give $1 billion valuation at that time. So it's about what problem are you solving at what point of time, and what market you are in, and are you fundamentally changing something, and how confident you are in doing what you're doing. You need to have that conviction, and it has to show in the team that you are. And if the team doesn't believe in their own dream, the investors won't believe. So you have to be doing it for the right reason, and you have to be, madly passionate about what you're doing. And then I think people do understand that, yes, there's a future, but the execution is the piece which is the missing piece, and execution happens only if you are madly in love with what you're trying to do. So I think there are lots of factors, and therefore when we look at businesses, we spend a lot of time with the entrepreneurs and the team, trying to understand why they're doing what they're doing, and find, it's very easy to put it on Excel or a PowerPoint, look at the market size, look at the opportunity, look at this problem, nobody has solved it before. All that presentation can be made by somebody who's doing purely an academic exercise, right? You don't invest in someone who's just doing academic exercise, right? So somebody who's making the presentation has to argue that, this is an opportunity that they see, and they are the ones who are the right people to really capture that opportunity and execute on that, and they have planned for everything that can go wrong, and they figured out what can go wrong and how they will react to that situation. So unless you're able to answer all those questions, you're not able to demonstrate why you're doing what. Yeah, you're on mute, Sheetal.
So you said that that the entrepreneur must be really passionate and love what they do, and so that was my next question. So an idea and passion is the start of an entrepreneurship. However, to create numbers, the initial thought is lost in transition. Somewhere along, the entrepreneur loses sight of why they started the journey and how important is it for the venture capitalist to have this passion burning in the entrepreneur.
So, I'll go back to my example of Flipkart. When Flipkart started, they were selling books online, right? So basically, you can start with a problem which you think is the problem you're solving, and the business can evolve. And I've seen entrepreneurs who actually change with the situation; they do the best. And that's the reason, as you keep evolving with the evolution happening in the market. And I've seen, for example, what's happening during pandemic, during COVID times. Things have substantially changed, and entrepreneurs who actually were nimble, flexible, to really immediately respond to the situation were able to really sustain and in fact do even better than what one would have expected if the pandemic had not happened. In fact, one of the biggest examples I've seen is that, and to your earlier point, that people were actually burning a lot of money, putting in money, just, making sure that at least they are capturing more and more market, just do the land grab and, then figure out the profitability later on. I think pandemic changed that mindset substantially because the focus immediately shifted from top line to bottom line. Because you really didn't know, first of all, how long is this going to last. And if you don't know how long this is going to last, you only have limited cash sitting with you. And if you have limited cash sitting with you, if that runs out, that's your oxygen, and you survive on oxygen. As the cash runs out, you're dead. So therefore, the entrepreneurs started cutting their costs, which were non-essential costs.
Yeah.
And they've done a great job. I've seen that, a substantially large number of entrepreneurs have actually survived, and not only survived, they actually thrived during this entire last 8 to 9 months, mainly because they knew exactly where to cut their cost and where to really play their cards. And I think it's quite interesting. And one of the questions typically people ask me is, did you see the valuations coming down during the pandemic time? And my answer is that actually, I haven't seen valuations coming down for the businesses that matter. In fact, the businesses where I want to invest, there actually the valuations have come down because entrepreneurs actually, stuck to their principles and they were able to handle situations very well. And in the process, they were very clear that, they would not dilute their stake unless, they get the right people coming on board and at the right price. And I think on the other side, people who could not survive, they anyways could not survive. And I think in those cases, even investors lost interest. So I think, clearly there was a segregation in terms of businesses which actually came out winners in this whole situation, and the businesses who could not sustain. And I think we'll see a lot more of that in the next few months, because some of them may have survived until now, but are now struggling to continue to survive. But I think, the right entrepreneurs who are doing it for the right reason, or passionate about it, they have been able to, carry on and manage it well.
Right. So, so yeah, in fact, the pandemic. So, having said that, has the COVID impacted your decisions on what businesses to invest in? And is it a trend in the venture capitalist group? And if so, would this become a very crowded space?
So I think it did to some extent, lead to some refocusing of energies in the venture capital ecosystem. For example, everybody knew that wherever you're using technology, wherever you're using platforms like these, wherever you are able to deliver products and services without having physical interaction, those businesses naturally were going to do well. So things like education, healthcare, even e-commerce deliveries, and food based on cloud kitchen models, fintech services, and a few others, I think were clear winners in the sense that, there was a substantial shift that we've seen, in fact, for the last 8 months. People were not willing to change mindsets from going to the store and buying, specific items at the stores, to actually then going homes and actually now ordering online. There was a large segment of people who were not willing to come online. And in the last 6 to 8 months, we've actually seen the kinds of people who are coming online, which would have never gone online. However, different product categories have seen different kind of adoption. We have a company called Bluestone, which is a jewelry company, and it was a online first jewelry company. So they never had a offline stores when they started the business. In fact, that was the whole thesis, that we can sell jewelry purely online with all kind of technologies. And if you go to the website, you will see, every piece of jewelry has a very nice rendered video where you can see lots of details of the product and a 360-degree view. And I think that thesis, original hypothesis, was interesting. But what we realized, given the price point of these products, people still wanted to actually touch and feel the product. And then we started the try at home model, where we said, okay, fine. We still don't want to have stores because the stores are very expensive. We would let people select the designs and let them call us home. And then we had an army of people going homes with those designs, which are not originals. But the designs were exactly what they were looking for, but not the original product. And that worked to some extent. But then we realized that, last year, that this is a product category which has to have an offline online mix. Even if you like the design online, you still want to go offline and buy it. You first go to an offline store, you liked it, but you're still not sure whether you want to buy it at that point. Now you want to come online and you see the same product, says, I've already touched it, I know how it is, I can place the order online. So despite the pandemic, interestingly, of course, the first 3 months were challenging because only essentials were allowed to operate, so they could not operate their factories. But after that, they have scaled up very well. In fact, the kind of numbers they are seeing now are much better than what they would have expected even before pandemic. And this is primarily because even if the industry would have shrunk a little bit, there is a substantial move from offline to online, which is very visible on their numbers. So I think that's the point I was trying to make, is that if you're doing the right thing with the right intent, with the right approach, and I think, and you're in the right market, and I think in this particular case, things actually worked in their favor. So that's an example which I thought is quite relevant to mention.
So you believe that still that businesses will come back or will work, irrelevant. It's not just going to be certain types of business, but we have an opportunity to work across different kinds of businesses. Because today what I hear is, pharma, it's digital, it's all deliveries. These are the ones that are going to really work. And I have personally seen a change in the way I shop, which I never used to. I mean, I do not want to go to a store. I find it now, painful to do that. I'm like, if everything's available on my phone, why do I want to spend my time and waste it and go to a shopping mall or a store to buy anything. So
Absolutely.
I see everybody's way of shopping or looking at things has changed dramatically in the last 6 months. And I'm just wondering that does that mean that businesses are going to change the way they're going to function? Are certain businesses going to stay and certain businesses going to have to shut shop? What is going to happen? I mean, what is your thought?
Yeah, I think there is going to be some permanent changes that are going to happen. So imagine uh, having a medical illness and not going to the doctor, and getting medical advice. And of course, even today, for the first interaction, if it's a serious issue, you still need to go to the doctor. You would want to go to the doctor and make sure that the doctor sees the problem and then tells you. But I think majority of the cases, people are fine just having a video chat with the doctor and sharing the problem. So that was happening to some extent. I mean, telemedicine started a while ago, many years ago, in fact. But all of a sudden, because of pandemic, people's mindsets changed and they wanted to, they were comfortable with it. Same thing with the education, schools, teacher-student interaction. How many schools are open at this stage? People are still taking their classes online and doing a good job. And therefore ancillary businesses around that, right? So education, healthcare, some of these changes are going to be permanent changes, right? So people's mindsets are aligned with the fact that you can actually achieve the same outcome without actually stepping out of your houses. You would want to continue with that. Of course, there'll be some changes around those. For example, people realize that you need better speeds at homes. You need a better corner somewhere in the room. So I need to make modifications in my house where I can take my laptop and sit down there, and things like those. Those are some of the and things like delivery points, and consolidation or aggregation of demands at the society level, at the building levels, and some of the new business models which have emerged over the last few months. So you will see some of these changes, new business models emerging, new ancillary ideas coming up, and some of these directions going in permanently irreversible things happening. So, but in the overall scheme of things, I think historically this has happened multiple times. Every time a big event happens historically, it does change habits, ways of doing things, right? So when computers came for the first time, fundamentally changed the way things were done. So this is part of that transition that we are seeing right now.
Right. So as much as I would love to ask you a few more questions, I think I should open this up to the audience. And I find that some of the questions are quite similar. A lot of people want to know, how do they find a co-founder?
How do they find a co-founder?
Co-founder, yeah.
It's always, I think, finding a co-founder, first of all, it's not easy. In fact, some of the people who come to me at the idea stage, and if they're coming with idea and they're the only ones just thinking of the idea, the first thing I've asked them is, go look for a co-founder. And co-founder is about not just finding a person. I think it's also about, entrepreneurship is not easy, right? I mean, it requires a lot of work, and you only have 24 hours in a day, right? Risk is extremely high. The odds are against you. Everything has the possibility of going wrong, right? And there is going to be that one thing at least which you would not have anticipated, and suddenly something goes wrong. So therefore, a co-founder is always a good idea to begin with, right? So now the question is, who should you get on board? I think one should do proper kind of search for that. Ideally start with someone who's been your friend from childhood, who you worked with in your job, who you studied with in college. You know the person for a while, the attitude of the person, the aptitude of the person, how they behave when things go wrong. It's very important to have seen the person in different situations. uh, you know it's almost like a love marriage versus arranged marriage. So if you actually known the person for a while, what are the what are the areas where they are strong in and what the areas they are weak in, and then see whether there is a match there. But it's very important to have a co-founder also, because an investor looks at it positively. Because investors, even though as a single co-founder or as a single founder, you may believe that you can get done things, you can wear multiple hats and you can do everything. But the way investors see it is that probably you were not able to convince anybody else, to bring on board. And if you couldn't convince a co-founder to come on board, and you're now trying to convince the investor, it's much harder to convince an investor if you could not convince a co-founder to come on board.
Right. Okay, I don't see any more questions.
Actually, we do have one more from Ankit Singh. Ankit, would you like to unmute yourself and ask your question?
Okay. Yeah, now I see it. Yeah.
Okay, what I can do is I can just read out the question. Ankit has asked, how do we start a project or business when capital upfront is zero? So how does that situation convert into capitalist investment in my idea? And how does the fiscal value of business and the entrepreneur himself evolves? I hope I got the question right. Ankit, if you want to chip in and you want to rephrase something, feel free to do so. In the meantime, Vikram, may I ask you to kindly address it?
This is, unless you are starting an airline business on day one, where you need to buy airplanes, or you're starting a car rental business, or something which you need to buy an assets yourself, where you need capital on day one. It's very difficult to start a business without initial capital, right? So, I'll give you my own example. When I started IvyCap in 2011, people don't believe me on this, but I think this is something which, this is a reality, that my bank balance was zero, actually, on the day when I started IvyCap. And not only zero, in fact, I had, a family to support. I had a home which was mortgaged, and I just wanted to do venture capital, and I just wanted to do it. And I knew that to do venture capital, you have to have capital, right? So, I mean, that's the first thing that you need. And how do you go and convince somebody else to give their capital to you when you're not putting in your capital to invest? So, the idea that I came up with was something which I believed in, and I thought that it will work and I will be able to get the right people on board. So I actually, borrowed money against my own home, which, for 8 months, I had only enough capital to survive for myself for 8 months. So that is 6 months, I'll try this idea. And for the remaining 2 months, I will go back to the job market and look for a job, so that at least I can pay off the loan which I've taken. And I think fortunately the idea worked out, and it was a tough call. And I can tell you that in retrospect, will I do it again? I'm not sure, because it was very risky. But that experience itself taught me a lot, and the way, therefore, I'm able to handle the money today. And that itself, investors saw as a mindset where they believe that, because I come with that background, I will be able to handle their money as if it is my own money. And this is exactly how it happens. And that's the reason, fortunately, things have worked out very well. So I think if you believe in yourself, if you believe in the idea you're working on, somehow you start getting lucky. And that's exactly what happened with me. And then when you talk to people and you start, telling them about why you're doing what you're doing, your story naturally comes out, and people look into your eyes and they see the genuineness of the cause that you're trying to go after. And it works out. I think I have seen whenever you are actually very passionate about what you want to do, irrespective of Capital, I think, is, to me, many times entrepreneurs think that's the number one problem. I believe capital is the last problem one should think about. I think you have to think about other problems first. You have to think about whether you're actually doing it for the right reason. You're solving the right problem. Are you the right person? Do you have the right team to do it? And do you have the right set of relationships? I think the network that you have becomes very important. And I consciously spend time on building that network. There are lots of those factors. And then if you have the right network, somebody in that network, will have the capital to invest in you. And if they believe in you, they will invest.
Okay, I think I see another question from Arpana Bhatnagar. Arpana Bhatnagar, can you unmute yourself and ask the question? Okay. So
yeah, hi.
Yeah.
Hi. So my question is, if I'm bringing on a co-founder after a couple of years of running the business, what kind of equity looks good to be offered to co-founders coming in?
Yeah, very good question, Aparna. I think, and it's a very hard question to answer because every individual thinks differently in terms of what value they can bring to the table. And the other person also have to appreciate the value that they believe they can bring to the table, right? So, for example, when I was starting IvyCap, I met someone who I thought could bring a lot of value. And I said, why don't you come on board and we will do, we agreed on a 50-50 equity. And then we even shook hands. And then while we were celebrating the whole starting point, he just made a comment saying, hey, great, you get started. I'll support you from outside. Another 6 months, I'll be fully on board. But yes, we will be 50-50 partnership. So I was like, excuse me, I think that means you don't want to take the risk, but you want the upside. So effectively, it's actually a lot of factors that go into this, right? So one is, how much value do you think the person brings to the table? How much time they're contributing? How much risk they are taking? And how much you believe in that person? And typically, and then there are other factors also in terms of, the comfort with each other, the decision-making process. And typically, if you believe that, you have enough understanding of the business and you'll be able to control the growth of the business, or provide leadership for growth, then I think, it's okay to kind of own a substantial majority in the company and then bring people on board with the significant minority. And if people come a little later, after you have done a lot of work, then it's okay to work on an ESOP model where, people get equity as they create value. So I think you'll have to structure it in such a way that, people on one side see that value in the future, and on the other side see the value coming to them as well. Those numbers are very situation and case specific, so I can't give a generic response to that, but you'll have to look at specific people, specific situations, specific business, etc. So lots of other things go into it.
Okay. The other question is from Pooja. Pooja, would you like to ask the question? Pooja? Okay, so she's asked a very simple question. To what do you attribute your success?
On success, I think, success itself is a subjective term. I think I would say that, I have seen success over time, but am I successful to what I'm actually eventually trying to achieve? Maybe not yet. But yes, whatever I've achieved so far, I would say that I'm very thankful to my family who has supported me at the time when I was thinking of the whole idea of starting a business. Of course, I've learned a lot at every stage of my life. In my college days, I've had very good friends. I do believe that you have to make conscious choice of your friends, the kind of people you interact with. also was very fortunate to work with right people during my work experience, having worked globally in different geographies, US and other geographies. Uh, I would say I was lucky as well. But I think on top of all this, there are few things that I've learned in life. And I think that's number one. I think you need to have a vision. You need to know, what direction you're going to, and why do you exist in the first place. The whole purpose of your existence, I think you have to, if you don't know it yet, and majority of the people don't know, keep asking that question to yourself. And if you still can't get an answer, maybe get a few people around you, so-called mentors or some advisors, and brainstorm with them, ideally people who know you. Once you know your purpose, then at least you have a direction. And then it comes to planning. I think you have to make a plan. A plan, it has to be very well thought through. While it thinks about all the positive scenarios, you have to think about what can go wrong, because things will go wrong. And you will have to plan for, if things do go wrong, what are your backup plans. And I think that, to me, is the most important thing which I would attribute success to. Because people who actually fall off their track, their path, that happens only because they did not create those cases or situations or scenarios where things can completely go off track. So you have to think through those scenarios early on. And so that's part of the planning. Third is discipline. And I think discipline, I've seen, and that discipline boils down to one most fundamental and important aspect, which is the timing or the timeline, or maintaining everything on time. If you're committed to a meeting at 4 o'clock, it's better to be 15 minutes earlier than 1 minute late. So making sure that you respect everybody else's time. People will respect your time if you respect their time. And that's one of the biggest reasons why I would believe that people respect. I've found more friends, who actually have respected me over time purely because of that. And then last but not the least, never be scared of hard work and execution. Therefore, put in hours, because there's no substitute to hard work. Even if you're not as smart or as intelligent as somebody out there, but if you're putting more hours than that person, I can tell you that you'll be much more successful than that person. So I think these four things I've seen have worked very well, for me.
Right. We have one more question. It's from Surbi. Surbi, would you like to ask? Surbi? Okay. So I'll ask on her behalf. What are our respective personal goals for startup? Example, a sustainable business that is spinning off cash and running it forever, or high growth and some type of liquidity event.
I'm trying to understand this question. What are our respective personal goals for the startup? Example, a sustainable business that is spinning off cash and running it forever, or high growth. Maybe I think I'm probably understanding this. So I think probably what you're trying to ask is, if you have an option where somebody wants to buy you out versus you want to continue running it, and if you have a liquidity event where, let's say somebody comes and puts value to your business and says, hey, I want to buy you out, and you may have planned to go $1 billion valuation, and somebody came on the way and said, while you may be thinking of $1 billion, but I'll buy you at 100 million. The question is, would you sell at 100 million, or would you want to continue to take it to $1 billion valuation? Now, I think, it's a very tricky question. And this is exactly a situation we're facing in one of our companies right now, where when we invested in this company last year, we made a very small investment of $3 million. And I knew that the business was going to go to substantially higher valuation, if not $1 billion. And this year, somebody came and offered a 5x of my entry price, was willing to just buy me out. And I think every situation has to be evaluated based on its merits, pluses and minuses. And I actually did exactly the same. I looked at all those scenarios, and and it also boils down to many times a bird in hand better than two in the bush, I think, kind of a situation. And what are you going to do with that money? Or do you have alternative plans? But if you are so passionately attached to your business that you don't care about that value at that time, you would rather want to continue. But there are always risks associated with those things. So you'll have to assess those risks at that point of time, and make sure that you're convinced about carrying on, because there's always this combination that works in your mind, which is the fear and greed. Greed always likes you to keep going, and fear is always something that kind of people try to put in your mind that if you don't do it, things are not going to happen. So eventually listen to your mind as well as heart, and it's not an easy exercise.
So Gauri, do we have any more questions? I think
those were
addressed
all. And actually, that's an excellent note to end the session on. I think my personal takeaways from this session is when Mr. Gupta said that valuation of a business depends upon who's doing the valuation.
Yeah.
That's like a light bulb moment. Something went off. And also when he said that when you're you cannot be batting with one eye on the scorecard at every time you hit a ball. And that is so true. And actually, on that note, I would like to extend a warm note of thanks to Mr. Vikram Gupta for taking this session on today. Sheetal, for actually breaking down the questions that our participants might have from their perspective, and really translating balancing out the unicorn and the basic fundamental questions that entrepreneurs might have during the session. I would also like to extend thanks to our FICCIFLO team, our Millionminds team, which is actually on ground and spreading this message to the participants, as well as IIT Bombay. Thank you all to the participants as well for taking out time and attending the session. Hope this was useful and it gave you a lot of insights as it did to us. And that's it. I hope you all have a good weekend.
Thank
you,
you.
Vikram.
Thank you.
Thank you so much.
Thank you, Gauri.
Let me Sheetal, Gauri, of course, Archana, and the Vertices team, and Vicky as well, and brilliant questions. And thank you so much for having me here.